Office sharing company WeWork has filed for Chapter 11 bankruptcy protection in the US. Valued at $47 billion in 2019 in a round led by SoftBank, the company tried and failed to get public 5 years ago. It debuted through a special purpose acquisition company in 2021, but has since lost about 98% of its value. The company in mid-August announced a 1-to-40 reverse stock split to get its shares trading back above $1, a requirement for keeping its listing on the New York Stock Exchange. The company reported liabilities ranging from $10 billion to $50 billion in its filing, which is limited to its locations in the US and Canada. For more, let's bring in Russ Mould. He's investment director at AJ Bell and joins us from London. Russ, thanks for joining us this morning. Now, WeWork's collapse into bankruptcy is the culmination of a years-long saga for the company. Talk us through how we got here.
You first of all have an inherently very risky business model where you lease a lot of building, a lot of real estate, and then look to sublease it to smaller companies, younger companies who maybe can't afford a big building of their own. So you take a lot of liabilities on at the start and then look to get your income in much further down the road. So there's a big mismatch there. And you're also dealing with smaller companies who could quickly get into the most trouble if there's any economic bad news. Now, there maybe hasn't been a lot of economic bad news, but there was a very big pandemic, which means that demand for commercial real estate has been weak. So that has revealed the inherent risks in the model. You then have a company that is 12 years old, has never made a profit, is still losing $1 billion a year, and has burned through $20-odd billion from its investors. So it's not really proved that its model works. And then ultimately, you have the liabilities that it has, leases and debt, which it is now unable to fund, at least in the US and Canada, because it isn't making any money.
Right, and we know from this filing that it only covers their locations in the US and Canada. Could their other listings around the world also be in trouble?
Looking at the last accounts, America and Canada are roughly 40% of revenues and around half of assets. There have been issues in the United Kingdom, for example, which is about 15% of assets. A landlord here called Helical cancelled leases that WeWork had for non-payment of rent. It then returned those leases on a short-term basis in exchange for a new agreement. But yes, WeWork is finding it difficult in other parts of the world as well.
Right, Russ Mould, AJ Bell, Investment Director there for us in London. Thank you for your insights.
Thank you.
Now to other top stories from around the world. China's exports have fallen for a 6th consecutive month in October due to lower global demand amid higher interest rates. Shipments abroad dropped 6.4% from a year ago, while imports surprised analysts with 3% growth. China's trade surplus declined 31% to $56.5 billion, the smallest figure in 17 months. Australia's central bank has raised its interest rate to a 12-year high of 4.35%, the first hike since June. It comes in response to persistent inflation in the country, with officials saying it's past its peak but still remains too high. The Reserve Bank of Australia's decision to raise rates runs contrary to decisions of the Federal Reserve and European Central Bank, who've opted to hold rates steady in the past month. And Saudi Arabia's Aramco has reported a steep fall in its third quarter earnings due to the impact of lower crude oil prices and volume sold. Net profit at the Saudi state oil giant plunged 23% year-on-year to $32.6 billion. Energy prices have shot up since the Gaza onslaught began, but they are still well under last year's record levels.